Hello guys and welcome back to the channel. So today we're going to review a stock that is down 9% today. This is a very famous retail stock, and to be honest, I have been too focused on Palantir and Tesla, and I want to grow the stocks that I cover and my portfolio of stocks because it's a bit too crazy. I've been saying it from the beginning that the only reason why I'm 100% invested in Palantir is because I'm going to substantially grow my stock market portfolio, and Palantir was a company that I was very sure in at that time, but I have more money coming to the stock market and I need to find more stocks that I can invest into, and this stock is down almost 9% today, and I decided to, take a very heavy look at it. So is it a buy today? Is it something that I want today? What do I think about this stock? How do I value this stock? This is all coming up in this video. So if you like it, all I ask is that you press the like button and the subscribe button. So let's go. So what is Enphase? Enphase is an energy technology company that is the world's leading supplier of microinverter based solar plus storage system. The company delivers smart and easy to use solutions that connect solar generation, storage and energy management on one intelligent platform. So as far as I understood so far on the research, and I'm definitely going to research this company more because of one very important thing that will come later in the video. But they started with this micro inverters, which achieve a very big energy efficiency from the solar panels. And then they branched out, and they have this chart somewhere in their investor presentation that the share that they can get from a house grew from 2,000 in 2020 to 6,000 in 2021 to 12,000 in 2022. And I really like this. So they're branching out and they're trying to be an all-around energy solution company. So I read a lot about the company, went through their reports. I have more research to do, but the company looks very, very promising. And fun fact, they have been the last 5 years, there was a period when they were up like 100 times, which is crazy, and they were the best performing stock out of the whole S&P 500. But they have been going down like every stock recently, and this can potentially give us a very big buying opportunity. When you look through this company, I went through their income statement, and they're growing crazy fast, and their balance sheet looks quite good. They have very little debt. Actually, that's not true. They have about $1 billion in debt, but why I said very little is because they made 256 million in operating cash flow last year, and this 1 billion could be paid off with 4 years of cash flow, and I think that that's a very healthy debt, especially when they're growing so fast and they are growing with profits, so that is in no way a problem for this company. So here's my valuation model. Currently the stock is $25 billion. And by the way, if you join Patreon for $5 a month, you get access to exclusive videos, and you also get access to my valuation models. And what's so nice with this one is that I tell you the logic in this one and what I'm looking for, and then you can put in your own assumptions, and it's going to show you, based on what your targets are with the stock, if it's a good buy or not at the current level. So you get access to that for $5 a month. It's the first link in the description box below. Currently the PE of the stock is 70%, which is normally very high. However, when you take the growth into account, they grew about 70% last year, and they did that profitably. So even with this super high PE, they are at a PEG ratio of 1 or below 1, which per Peter Lynch is a very, very cheap company. So obviously the question with this company is, are they going to be able to keep growing with this pace? And obviously they are not, so they're going to probably slow down on the growth. And this is where me and the analysts disagree, and I'm going to go into this. But if you're a bull of this company, you are even if it's not 70%, I calculated with 40% growth until 2026 and then 30% compounded growth from that point until 2030. And when I look at companies, I basically want to hold them for at least 10 years, and I like to buy companies where I can see a trend that I will be able to hold this company, 20, 30 years into the future. And because they are a solar energy provider, they have a huge secular trend behind their back. So I really love this about this company, because I'm not a trader. I'm a guy who has a real estate development business. We're building hundreds of apartments, and I don't have time to micromanage my investments. I have to focus in on a few stocks that I'm sure is going to go up in the next 10 years. And then I have to make videos about them. So that's my job. And I really like the fact that it has this secular trend, and this company is going to be here and is going to be thriving 10 years from now and 20 years from now. The question is, how well are they going to be doing? So it's not an if, it's how well they are going to be doing. So their free cash flow last year was 237 million. That is very, very healthy. That is less than 1% of their valuation. So based on the free cash flow, the valuation is like 100 PE or something like that. Their price to sales is 10.73. Again, when you just look at these numbers, they're crazy high. And I want to acknowledge that, okay? But when you look at, okay, so when you have a high valuation, it's not something that should scare you off from investing in stock, because, for example, Tesla, that you cannot really find a time except for now, but in 2019 and before, you cannot find a time when that stock was cheap. The same with Amazon. And even today, it's not a cheap company on paper when you look at these metrics. So you have to put everything into context. And again, what's really going good for this company is their crazy profitable growth. So it's not just that they're a growth company, they're a profitable growth company, and GAAP profitable, unlike Palantir. I mean, okay, Palantir was also GAAP profitable the last earnings, but it's not with shenanigans with, stock-based compensation and we don't pay the employees. It's actual GAAP profitability. So if we look at the assumptions, and by the way, they're so nice on presenting their company and how the investors should think with. They are saying that the next few years ahead, we're planning to have 40% gross profit, 15% expenses, and 20% profit. And as an investor, it's fantastic to hear that, because it makes the evaluation very, very simple. So we just take these two numbers. We take the operating margin, we take the revenue, and this was 2.3 billion last year. I assume a 40% growth until 2026. So you can see that the revenue is growing 40%, and then after that it's growing 30%. Now, if you look at Yahoo and the analysts that are here, they are saying that this company is going to grow about 20% year on year for the next 5 years. And this is where we really, really disagree with analysts. You see here 20%. And in the past 5 years, they were growing 141% per year in average. The thing is why I think that they are way off is because just in Q1, when you look at their latest guidance in their investing reports, that is here somewhere. This is so typical that I don't have it just when I'm shooting the video. Anyways, they are projecting a 70% increase already in Q1. So to have them only grow 20% after 70% Q1 is almost like they have to stop growing. So here is their financial performance. I don't find where they had the forecast, but I remember the number that it was between 700 million to 740 million. So now if you put that on this chart, this is 2020, 2021, 2022 Q1, and 2023 Q1 would be 700 million, somewhere up here. So is that something that looks like it's slowing or speeding up, or I don't know. To me, it definitely looks like they're not slowing down, right? So The company currently is doing 70%. I don't think that that is sustainable. The analysts are predicting 20%. I am like somewhere in the middle. And the company said that they're going to have a 20% profit margin, and they had 19% in 2022. I went a bit more pessimistic and I said, okay, 18%, even if they F up or, you know, do something, 18% I feel really, really safe in. I actually even looked into their share dilution, like how much stock-based compensation they do. And the last 3 years, they had less than 1% stock dilution, which again is very, very nice. It's a growth company that is profitably growing and is not diluting shares. I mean, whoa, it's like the opposite of Palantir. So what does my table say? In 2025, if they grow as we think that they would grow, the operating income would be just over $1 billion. And if you put a 40p on it, which would still be very undervalued for a company that is growing 40% year on year, it would be still a 1 PEG ratio, but the market cap would be 46 million. And if you divide that back with the diluted shares, the share price would be 310. So if you want a 20% per year return until 2025, I even have to check if this was calculated correctly. 1, 2, 3. Okay, yeah, it is calculated correctly. So then the stock price would have to be $180 dollars basically, or below that. And if you want to have the same up to 2030, let me make my face smaller. You are okay with the stock price being below 228. So the stock price with this fall was 183, which is just over my my 180 target, or it's actually below my 10-year target. So I normally like to have a 30% return because I am afraid that I miscalculate things. For that, the stock should be below $141. I don't think that that is going to happen. And to be honest, I am going to do more research on this company. However, I would be, if my money was out on the stock market and my research is done, I would be okay with the 20% just because they have such a strong secular wind on the company. So where do I still have insecurities? So I want to do more research about the company's growth, because just like the other companies that I'm invested in, the valuation of this company lives or dies on the company's growth. So if the growth significantly slows down, the company is worth almost nothing. I mean, you can see if I just change the growth down to 20%, then the target stock price basically goes in half. So you can see that a huge part of this company's valuation is the fact that they are growing. So I want to make sure that I fully understand the company and I know the insides out. That's what we do on this channel. I don't want to cover like 100 stocks. I want to cover a few stocks, and I want to be a total complete nerd on those stocks. So I want to do more research because I'm not a complete nerd yet on Enphase. And what are the risks of this company? So they can get out innovated, but I'm very happy with their team and their innovation and the company culture. I read their company culture booklet, which was like, I don't know, super many pages, skimmed through the end. But I'm very happy with how they innovate and that they are taking more and more market share. And I'm very happy with their go-to-market approach, that they are making it very, very easy for installers to order the products, and they have very good customer service. It's because I myself am in the real estate business, as I said, with my company, and I know that it can be so hard when you're installing. We tried to actually install Tesla solar panels on one of our projects, and it was too little data. No installers knew what they were doing, and I mean, yeah, the biggest problem is that you couldn't order it. And so then the second risk that I don't like with this company is that they will be directly competing with Tesla on these solar products. However, I do think that Tesla is focusing on cars, full self-driving, and they don't even really sell the residential solar solutions, or not pushing them so much. So I believe that this company is executing really well, and this is not going to be a future problem, but definitely want to do more research there. And yeah, the plus points are that they have this super strong secular trend. They have a good balance sheet. It's not great because they do have debt on the balance sheet, but because of their growth, it's not a problem. And they have a very, very good management. So this is a company that I definitely will do a lot of research on, and I will cover it for you guys. And let me know in the comments, are you excited about this company? Do you have a position in this company? Do you think my growth estimates are correct or wrong? And please, I want disagreements in the comments. So if you disagree with anything, I want to see where I'm possibly wrong on my thesis with this company. And thank you so much for watching. Remember to check out the Patreon link and subscribe if you haven't yet, and I'll see you in the next video. Ciao, ciao.